Now let's shift gears to our special guest. We do have a special guest tonight. His name is Mike Dever. Mike's with the Brandywine Asset Management, founded 30 years ago. But he's also an author in the investment world, has an interesting title to his book, and we're looking forward to meeting him. Michael, how are you?
Very good, thank you.
Good to be with you. Tell us a little bit about your experience in the business, what you've seen in asset management, and what led you to write, I think, several books, but you're going to talk about your most recent.
Certainly. Well, I've been trading, investing since 1979, so over 30 years in the business. And what led to this book was really just the repeated myths that I would be hearing throughout the financial industry. Things that people would hear, they would repeat it, and it would get repeated even without evidence that it was actually a truth and not a myth. And it was 1999 when I came up with the idea for this book. It took me over a decade to write it. And actually research it, but it was that experience of just hearing things that I knew to be wrong from my experience. But
why don't you show our viewers the book so they
Sure.
can see the name of the book, the title of the book. The book is called Jackass Investing, and I hope my name's not in there.
Right. The tagline is "Don't do it, profit from it."
Okay. Thank you, Mike.
Certainly.
So you hit on some of the myths. What are some of the more common ones that you run across?
Well, the first myth I start with is stocks provide an intrinsic return. And the reason that's a myth and not a truth is because people repeat it by just looking at history and saying, well, stocks went up, they averaged 10% a year for the last century, so that's the return you expect from stocks. So what we did was actually go through and figure out what were the return drivers that actually drove stock prices. And if you do a little bit of analysis, what you see, there's really two primary return drivers. In periods of less than 20 years, the dominant return drivers that affect stock prices is the PE ratio. It's the enthusiasm people have for either owning stocks or not owning stocks. And over 20 years, it starts to skew more towards being corporate earnings growth. But that's really interesting because you could have a decade, like we've had, where you have strong earnings growth and stock prices go nowhere because the PE contracts. So it's when you get down to it, it's those return drivers. And that leads to a lot of what I talk about through the book is identifying the return drivers for every investment you're going to make. And understanding the return drivers, understanding whether the current environment is suitable for those. So that was one of the main ones. The last myth I put in the book, there is no free lunch. That's the myth that you can't earn a higher return with less risk. And the reason that's a myth, and the reason it's not a fact, but the reason people believe it to be truth, is because they start with a boxed-in universe of investment options. And they say, well, if I stay within this box, I want to get more return, I have to leverage it up some, and I'm going to take on more risk. And what I point out throughout the entire book is that there are numerous trading strategies involved in numerous investment areas outside of what's conventional, like a 60-40 stock split. And when you expand beyond that into those other areas, you can actually increase your return and lower your risk at the same time.
Oh, I'll be interested to hear about that. I want to comment on one of the things you said because I think it's very relevant today. And again, as Brian had said, our show is taped, so please be cognizant of that. So we don't know exactly where things are today. But I can tell you today, the S&P 500 is in the mid to high 1300s. And that, what you had said, is I think very relevant right now because it's been here two other times in the last 10, 11 years. And then what happened? The bottom dropped out, and we dropped 50% both times. And I think people are really saying, fairly so, here we go again. But I think what they need to be reminded of is what you had just said, that the PE today on the S&P 500 is half of what it was 11 years ago. Right. And it's about 40% of what it was the last time we were at this level. So just because it's at that level doesn't make it expensive. There's more important things that underlie that.
It still gets back to what people could continue to get more negative, and the PE could contract more.
Sure.
But what people forget is, or maybe fail to really take into account, is that the big bull market we had from '82 to '99, 2000, that was caused in a big measure by a quadrupling of the PE from 1982 to 2000. So people take it into account and say, well, that's the kind of return you expect. Well, only if you had an additional quadrupling of the PE. Right. What we've seen in the last 10 years is the PE coming back into more of a normal long-term level.
Right, and but I think you make a great point. Like long-term, it's corporate earnings, and I think people really feel it's supply and demand that's driving everything in between. And I think that's where a lot of investors get caught up.
Yeah, and long term is longer than people
Right,
think.
yes,
And that's what we
no,
found
right,
out in
yeah.
doing the research for the book. A lot of people think 5 years, 10 years even is long term.
Right, 2
It's
days.
really over 20 years before the dominant return driver is earnings growth and not people's enthusiasm
Not
as measured
next
by
quarter?
PE.
not
I'm
next
sorry,
quarter.
I can't help you with that, right?
How about some other myths that are very, very common? I'd just like your thoughts on them, two of them. One would be, buy and hold. And another one would be, as you just maybe pointed out, invest for the long term.
Right, okay. So buy and hold, again, it works because people were looking at it over a long period of time and saying it made money. But if you really break down the last century, up until from the turn of the century, 1900s, up to around 1982, when the bull market started taking off again, or the bear market bottom saying 74, 75, stocks in real terms, dividends reinvested, didn't make any real money. They barely kept up with inflation. And the big return people had was in that bull market. That took off from that period of time. So buy and hold only works if the environment is right. And what I point out in the book also is there were entirely different baseline conditions in the United States for investing in stocks in 1900 than there are today in 2012. And we're not going to recreate that environment. We're not going to be emerging economy again. If we are,
Right.
that doesn't bode well for stocks between now and then. The other thing is that in 1900, there were 36 countries with active stock exchanges. And over the next 100 years, half of them went belly up at one point in time. There are only 4 of them that performed as well as the U.S. did. So you're essentially saying we picked the 1 in 10 shot, and that's the one we're looking back and using as the example. And you can't do that. You have to look at today. What are the baseline conditions? Are the return drivers valid today? Make your decision based on that, not just some sort of naive look back 110 years and say it made money then, it's going to do it again.
So obviously most people are trained buy and hold, and what are you telling them they should be doing? Obviously looking at return drivers, but what's your basic advice to the viewers or the listeners?
Right. So the main thing, though, throughout the book is to not have such a stock focus, actually. It's to diversify your portfolio across return drivers. And stocks are just one part of a portfolio. The type of things I do with my trading is the U.S. stock market is one out of about 100, 110 markets that we're trading in, which includes a variety of other markets, not just stock index, but interest rate markets and agricultural commodities, anything, because there's always some opportunity where a return driver is lining up and giving you a positive expectancy. There are times when with stocks you should just be sitting there saying, well, I shouldn't have big exposure in this because it's not a favorable environment. Either baseline conditions are off, it's what I call an angry environment, like we had in the financial crisis, or it's just the return drivers are out of whack at that point in time. PEs are too high, for example.
Right. That would fly into the face of another myth. I'm sure it's in your book, and I haven't read your book yet, but I will, I promise, is don't try to time the market. You can't time the market. Spend a lot of time in the market.
Right.
Obviously, you don't agree with that.
Well, it's interesting because the reason people say don't time the market is because if you look at things like the Dalbar studies that go back for the last 20 years, say 5% underperformance. People have underperformed the exact mutual funds they've gone into by 5% a year on average because they're mistiming their money in and out of those markets. Bond market's the same. It's a huge number that they're underperforming each year. What I point out in the book, and we actually developed a neat little trading strategy, and you were talking about some of the things earlier with the leveraged ETFs, for example, is that you can create a trading strategy that fades that behavior. And it's very logical. Instead of rushing in when everybody else is rushing in because stocks are going up and they want to jump in there, we measure the inflows into the leveraged ETFs, both the inverse and the direct ETFs. And what you'll see is when the inflows into the aggressive ETFs on the long side increase, you're near top. And you can, we actually
Like the
present
silver ETF, when it went through 50, money kept flying into
gold. Gold was the largest ETF in the world, right, when it reached its peak.
Right.
And that's what you see is very common. And I actually present a specific trading strategy, and we have that up on the website, where people can time the market based on this behavior, try to take that 5% away from the guys that are losing it every year, and use that to your advantage.
Which is funny because it's kind of contrarian. Which when you interview people, they all say they're contrarian investors. Yet the data proves time and time again they're not. Right?
No.
They're following the herd. They're the last one in. At the high.
80% of people are above average drivers, if you ask them.
Yes,
Right. And it's the same thing with investing.
Right.
They can't all be contrarians, obviously,
Right.
by definition.
You talk about passive versus active in the book. Can you explain, the difference and your take on
Sure.
on the two?
So passive, I mean, it's getting muddier with the different ETFs and things that are out there today, certainly. But classic passive investment is people put money in an S&P index fund and it tracks the S&P. My point that I make in the book is that nothing is passive. Nobody's just a buy and hold, do nothing investor. And I'll back into this with the story about Warren Buffett. Everybody looks at him as the long-term buy and hold kind of guy. Berkshire Hathaway had record amounts of cash going into the financial crisis. When the market fell out, he started deploying $5 billion chunks of that at the bottom again. He's a market timer. I mean, he's a smart, astute market timer, and he's a true contrarian. But with index funds and passive investing in index funds, you're relying on the index committee or some formula that tends to have subjective judgment to it to pick the stocks for you. My point is, and if you talk to the guys and you see what they write, they're just trying to be representative of the market. They're not trying to pick stocks that are going to outperform other stocks. But there's some fairly simple measures you can use to come up with ways of finding stocks that are more likely to outperform another stock. Not every company is equal. Not every stock is equally priced. And my point is follow a systematic process that's designed to maximize return and pick the better stocks, rather than following a process somebody else is using that's not designed to maximize return and is very subjective in a lot of cases. I give some examples like the Dow and stocks coming in and out of the Dow, and stocks in and out of the S&P, where it shows if you did the exact opposite thing, you would have outperformed the index committee's selections.
Selling the stocks that are going into the index and buying the ones coming out.
Exactly.
Because they had to sell them. Right?
They had to
sell the ones coming out,
right,
the indexes.
But I'm talking longer term after that. So for the
Okay.
year or two after that, the stocks they pulled out dramatically outperformed the stocks that they put in. And again, the index committee people, they're just people too, and they're subject to emotion. And if they've got a stock that's sitting there making them look bad, they don't want it to be listed as their 30 stocks all the time. They're gonna pull it out of there.
I just saw very recently I think when Apple Computer hit 600 for the first time, that and I don't know the year it was, but it wasn't long ago when they actually put Microsoft into the S&P 5. I'm sorry, the Dow. And they said if they had replaced that with Apple instead of with IBM, today the Dow Jones would be at 21,000.
Right.
One stock.
Yeah.
So
And that's one of the things I point out in the book. You're trading these indexes that are based on, for example, capitalization rate, or the Dow on a stock price. And I give the example. They couldn't put the Berkshire Hathaway A shares in there because it's 99% of the index price would be based on the fluctuation of that stock. 1% in there moves at 99% of the value of the Dow. You can't have it in there.
Can you talk a little bit more about how you're trying to replace asset classes, as most people just, let's look at the asset allocation with return drivers. Can you talk a little bit more and maybe give us an example of that?
Yeah, sure. So an asset class, they were formed, and I give some history of that, in the 1960s. And it came out of the guys that were writing all the portfolio theory, and they were trying to come up with ways of making allocations and portfolios. And the computers at the time weren't adequate to be able to do cross correlations on 4,000, 2,000, whatever stocks, and come up with the right mean variance allocations and stuff like that to put in there. So they started grouping things, and it made it usable for them. But and then people started breaking down those groups to subcategories and international stocks and emerging market and bonds and junk bonds, whatever. Sure. All those are long only positions in a like group of assets. And a trading strategy, on the other hand, is a concept based on some sound logical return driver that is looking at saying, okay, based on, for example, the strategy I gave that was looking at money flows in and out of ETFs and leveraging ETFs. There's a sound sentiment-based concept why that should make money over time by fading the crowd. And that's a return driver. So a trading strategy takes that return driver and turns it into a trading strategy by combining the return driver with a market that it's trading in and out of.
Okay.
So you can find a number of those return drivers, cause-effect relationships, apply them to a relevant market or group of markets, and you've got a trading strategy. All an asset class is a fixed trading strategy. It says I'm always going to be long in this, no matter whether the return driver says I should be or not, in this asset. That's the big difference.
Okay.
So when you look at it as return drivers, that's what opens up the ability of diversifying.
So when you invest, the way you're investing, what are your expectations for the portfolio, if you will?
Well, yeah. So our target returns are 12% with 8% standard deviation, maybe a 10% max, peak to trough drawdown. And I give some examples of free lunch portfolios that are not quite what we do, because ours is only for high net worth investors, the way we're structured, but it's available for an investor with a $65,000 portfolio or smaller. Things they can do using ETFs and mutual funds that are out there, because a lot of these things have proliferated over the years, and you've got these different opportunities that target somewhere around a third of the drawdown of like the S&P investment, with a couple % higher annualized return than an S&P investment. Mm-hmm. So it's a fairly dramatically improved risk-return profile by diversifying across return drivers rather than being stuck in asset classes.
You've talked several times, and I know in actually reading some reviews of your book, which were quite good, by the way, talking about the free lunch. And I know it's in your book, and I encourage the investors to buy the book and see them. There's several of them in there. Can you give us one example to the viewers, give them a taste of something that is, in your opinion, a free lunch?
Well, the free lunch is the concept of having broad strategy and market diversification in a portfolio. So examples of things that are in there, there's...
like the $65,000 portfolio, let's say, as an example. What does that consist of?
It's got some long-short funds in there. Okay, now long-short, what's interesting about long-short is, even though it's not till the long term that corporate growth really has a big impact on overall stock prices. By being long and short, market neutral, for example, in stocks, you essentially you pull out a lot of the PE effect, the emotion of the crowd, because they're all being kind of affected somewhat equally that way. Right. And so it gives an opportunity for actual corporate performance individually to shine and differentiate one stock from another. Okay. So it's got some long-short strategies in there. It's got some hedge funds type strategies, like convertible arbitrage in there. It's got managed futures component, which gives it a broad range of trading strategies across a broad range of markets, not just equities and financial assets.
Okay.
So, it sounds like a lot of work for an individual investor to do. Do you think it's a retail investor can really deploy it, or do you really need to turn to professionals like yourself and help them,
No, the idea with the book is that they don't have to. And so on the website, we have the action section on the website that lists the specific mutual funds and ETFs.
Why don't you give our viewers your website?
The website is www.jackassinvesting.com.
Okay.
Yeah.
All right.
And they can go in there and they can actually see then in the action section the specific portfolio to create a free lunch portfolio.
Is there any myth that we didn't touch on that is really one that you love to throw out because it's the most one of the most common? You hear it so often and you laugh when you hear it.
Maybe there is one, and that was that diversification failed in the 2008 financial crisis. Okay. And you hear that because people weren't really diversified.
Right.
They were long asset classes.
Or technology.
Right. Yeah. And when you have a financial baseline condition change and have that angry environment, all asset prices collapse, and if people are only long in financial assets, they're gonna have a loss at that point.
Okay. What do you see as the most attractive return driver right now? And obviously, we're not trying to time the show, but
that is hard for me to say because they're always changing. Right. We have a return driver for this is us today, so this is a couple months maybe before this show actually airs. We've got a strategy that trades in the natural gas market, and it's just looking for markets that are likely to reverse a trend. And natural gas has been in a big bear market, oversupply. Right. Had a warm winter, so there's been
all the bad things.
Everything, so we're almost near record lows, for the last decade or two, and we have a strategy that says, okay, this is a good point to buy Not necessarily to buy and hold, but buy when you get little, because what happens in a market gets low like that, it tends to bounce around in a volatile fashion. And so you buy it and you sell it and you buy it and sell it. You do that repeatedly. It's a strategy that over a 20-year period does really well, but it's only selectively imposed in the portfolio. This is one of those times right now.
We could go on forever. I appreciate your time. I'm sure there's more there. There's plenty more in the book. Please take a look at it. It's called Jackass Investing, again, by Mike Dever.